Property taxes are changing faster right now than at any point in the last 30 years. New exemptions are being created. New freeze programs are rolling out across the country. Some states are even offering to refund your property taxes entirely, while others implement assessment caps that limit how fast your bill can grow. We even have states working to eliminate property taxes on primary residences altogether. It sounds like great news, and it is, but here is the problem. Most of these programs are written in language that might as well be foreign to the average homeowner. Mill levies, assessed value versus market value, homestead exemptions, circuit breakers, floating exemptions, property tax deferrals. If you don't understand how these systems actually work, you can't take advantage of them. And if you can't take advantage of them, you are overpaying, potentially by thousands of dollars every single year. Welcome to Tax Hack Pro. Today, I am going to break down the new property tax changes in plain English. Not just what is changing, but how it actually works, what the technical terms really mean, and exactly what you need to do to benefit. By the end of this video, you will understand the property tax game well enough to win it. Let's start with the foundation, how your property tax bill is actually calculated. Because once you understand the formula, everything else makes sense. Here is the basic formula for property tax. Assessed value times tax rate equals your property tax bill. Looks simple, right? It isn't. Both parts of that equation are far more complicated than they appear, and understanding that complexity is the key to finding where the savings are hiding. Let's start with assessed value, because this is where most people get confused. Assessed value is not the same as market value. Market value is what your home would actually sell for, let's say $400,000, but assessed value, the number you are actually taxed on, can be very different. Many states only tax a percentage of your home's market value. This is called an assessment ratio. In Texas, they assess at 100%, so your $400,000 home is assessed at $400,000. But in Georgia, the assessment ratio is 40%, so that same $400,000 home is only assessed at $160,000. In South Carolina, the ratio for owner-occupied homes is just 4%, so your $400,000 home is assessed at only $16,000. Same home, same market value. Vastly different taxable value depending on where you live. If understanding property taxes better could save you money, hit that subscribe button for Tax Hack Pro. We break down these complex financial topics in plain English so you can actually use the information to protect your wallet. So your property tax is assessed value times tax rate, but assessed value varies wildly by state. And here is why that matters. When you hear about a $50,000 exemption, that exemption means completely different things in different states. In Texas, $50,000 off assessed value is $50,000 off your home's full value. In South Carolina, $50,000 off assessed value at their 4% ratio is a massive reduction that could wipe out your entire tax bill. The same exemption number has a completely different financial impact. Understanding your state-specific system is critical. Now, let's look at the other side of the equation, the tax rate, often called the mill levy. A mill is simply $1 of tax per $1,000 of assessed value. Or, put another way, 1/10 of 1%. So, a rate of 100 mills means you pay 10% of your assessed value in property tax. But here is what most people don't realize. Your tax rate isn't one single rate. It is multiple rates stacked together like layers of a cake. You have school district taxes, which are usually the biggest piece. Then you have county taxes, city or municipal taxes, and often special district taxes for things like fire protection, libraries, or local colleges. All of these combine into your total rate. When you hear about exemptions targeting school taxes, that is just one specific piece of your combined rate. Understanding this helps you see exactly where different relief programs target your bill. Let's put it together with an example. Take a $400,000 home. In a state with a 10% assessment ratio, that gives you $40,000 in assessed value. If you have a 100 mil tax rate, which equals 10%, you multiply 40,000 times 0.1. That is $4,000 in property tax. Now, here is the key insight. Relief programs target different parts of this formula. Exemptions reduce your assessed value, maybe taking it from $40,000 down to $20,000. Freezes lock your assessed value, so it can't go up even if the market does. Caps limit how much the assessed value can increase each year. Rate limits control the tax rate side of the equation. Once you understand the formula, you understand exactly where each type of relief applies. Assessed value times tax rate equals your property tax bill. That is the formula. Exemptions, freezes, caps, and rate limits all target different parts of that formula to reduce what you owe. But there are actually 5 main types of property tax relief, and states are rapidly expanding all of them right now. Exemptions, freezes, caps, deferrals, and refunds. Each works differently. Each has different requirements. And knowing which ones your state offers and which ones just expanded could save you thousands. Let's break down the 5 types of relief. Once you understand these 5 types, you can look at any state's programs and immediately understand what they are offering. Type 1, exemptions. They reduce your assessed value. Type 2, freezes. They lock your assessed value in place. Type 3, caps. They limit how fast your assessed value can grow. Type 4, deferrals. They let you postpone when you pay. Type 5, refunds. They give you money back after you've paid. Let's dive deeper into each one. Type 1, exemptions. An exemption reduces your assessed value by a fixed dollar amount. If you have a $100,000 homestead exemption, the first $100,000 of your assessed value simply isn't taxed. It is invisible to the tax system. Senior exemptions often add more on top. In Texas, for example, seniors get an additional $10,000 exemption beyond the $100,000 everyone gets. You usually apply once, and the exemption stays on file as long as you qualify. The big trend right now is that states are dramatically increasing exemption amounts. Texas went from $40,000 to $100,000 recently. Other states are following suit. Type 2, assessment freezes. A freeze locks your assessed value at a specific point in time. The most common version is that your assessed value freezes when you turn 65. Whatever the value was that year becomes your assessed value forever. The market can go up 50%, 100%. Your assessed value stays exactly where it was. This is the ultimate protection against being taxed out of your home due to gentrification or market booms. More and more states are adding freeze programs for seniors, and this trend is accelerating. Type 3, assessment caps. A cap limits how much your assessed value can increase in any given year. California's famous Proposition 13 caps increases at 2% annually. Florida's Save Our Homes program caps it at 3%. So even if the market jumps 20% in a single year, your assessed value can only go up by the capped amount. This prevents those shock bills, where your property tax suddenly doubles after post-pandemic value explosions. More states are implementing caps to protect homeowners from sudden spikes. Exemptions reduce your assessed value. Freezes lock it in place. Caps limit how fast it can grow. Those 3 all reduce what you owe, but the next 2 types work completely differently. Deferrals don't reduce what you owe, they change when you pay. And refunds actually give you money back after you've already paid. These last 2 types are expanding rapidly, and they are creating opportunities that didn't exist just a few years ago. Type 4, deferrals. A deferral program doesn't reduce what you owe, it postpones when you pay. The state or county effectively pays your property taxes for you right now. You don't write a check. Then when you sell your home or when your estate settles after you pass away, the deferred amount plus interest gets repaid. The interest rate is usually below market, significantly lower than a home equity loan or a reverse mortgage. Think of it as the government giving you a low-interest loan against your equity so you can stay in your home without the annual cash flow burden. These programs are becoming easier to access in multiple states. Type 5, refunds. Sometimes called circuit breakers, this is the most direct approach. You pay your property taxes like normal, then you file a form with the state. Based on your income and tax burden, the state sends you a refund, sometimes a partial refund, sometimes the whole thing. Nebraska's program can refund up to 100% of what you paid. It is called a circuit breaker because it breaks the circuit when your tax burden exceeds what your income can handle. This model is spreading to other states because it is simple, direct, and popular with voters. So you have 5 types of property tax relief: exemptions, freezes, caps, deferrals, and refunds. Each one targets your tax burden differently. And here is what is really happening. States are expanding all of them right now. There is a fierce competition for retirees, and property tax relief is becoming one of the biggest weapons in that war. What is happening right now isn't random. States are watching what other states do, and they are competing for retirees, competing for tax revenue from people who will spend money in their local economy, competing to keep long-term residents from fleeing to lower tax states like Florida or Tennessee. When Texas raised its homestead exemption to $100,000, other states noticed. When Nebraska started refunding property taxes, legislators in other states took notes. The result is more property tax relief for retirees than at any point in modern history. Let me show you the 5 specific trends driving this shift. Trend 1, record-breaking exemptions. Texas made history in November 2023, raising its homestead exemption from $40,000 to $100,000, the largest in America. But Texas isn't alone. States across the country are realizing that exemption amounts set 20 or 30 years ago don't work anymore. An exemption designed when homes cost $150,000 doesn't provide meaningful relief when homes cost $400,000. So exemption amounts are being raised dramatically. If your state hasn't raised its exemptions recently, watch for it. The pressure is building. Trend 2, freeze program expansion. More states are adding assessment freezes for seniors, programs that lock your assessed value at a fixed point so it can't rise. Why? Because being taxed out of your home became a major political issue. Stories of retirees who own their homes free and clear but couldn't afford the property taxes resonated with voters. Freeze programs are the direct response. If your state doesn't have a senior freeze, there may be one coming. This is one of the fastest growing categories of property tax relief. Trend 3, the refund model is spreading. Nebraska pioneered an aggressive approach. You pay your property taxes, file a form, and the state refunds up to 100% of what you paid. It is simple and direct, and it is politically popular because voters understand getting a check in the mail. Other states are exploring similar programs. When legislators see something that works and voters love, they copy it. The Nebraska model is being studied across the country. Trend 4, deferral programs are becoming more accessible. These programs let seniors stay in their homes without paying property taxes out of pocket. The state pays now and recoups later, but historically they were hard to access with strict income requirements and complicated applications. That is changing. Income limits are loosening. Interest rates are becoming more favorable. Application processes are being simplified. States recognize that deferral solves a real problem. Seniors who are house rich but cash poor shouldn't have to sell their homes just to pay property taxes. And Trend 5, the elimination movement. North Dakota is attempting something radical, eliminating property tax on primary residences entirely, not reducing it, not deferring it, eliminating it. The state would use oil and gas revenue to replace the lost local funding. If successful, North Dakota homeowners would pay zero property tax on their primary residence. No forms, no deadlines, no applications, just zero. Other states with resource wealth are watching closely. This is the most aggressive approach anyone has tried. Record exemptions, expanding freezes, spreading refunds, accessible deferrals, and even elimination. 5 trends transforming property taxes for retirees. But here is the critical truth that separates people who save thousands from people who pay full price. Knowing these programs exist is not enough. None of them come to you automatically. Every exemption requires an application. Every refund requires a form. Every deadline missed is a year of savings lost. Here is the frustrating reality. Almost nothing is automatic. You must apply for exemptions. You must file for refunds. You must enroll in deferral programs. Some programs require you to renew every single year, and nobody is going to come find you and tell you that you are missing out. The government isn't going to knock on your door and hand you money. If you don't take action, you don't get the savings. It is that simple and that frustrating. Why isn't it automatic? Think about it. The county doesn't know your age unless you tell them. They don't know your income unless you report it. They can't verify that a property is your primary residence without some kind of application process. And here is the uncomfortable truth. Budgets are often built assuming that a significant percentage of eligible people won't apply. The friction is sometimes deliberate. It keeps costs down. Different programs have different requirements, so there is no simple way to auto-enroll everyone. The system is designed to require your action. And then there is the deadline problem. Most property tax relief deadlines fall between January and April, the early months of the year. Miss the deadline by one day and you wait 12 months for another chance. No exceptions, no extensions, no sympathy. The bureaucracy doesn't care that you were busy or sick or didn't know. Late applications are usually rejected outright. The result, millions of dollars in exemptions go unclaimed every single year. Eligible seniors who don't know the programs exist. People who think they are already enrolled but aren't. People who meant to apply but missed the deadline. Your county is not going to call you to remind you. That money just stays on the table. And here is a distinction that catches a lot of people. Some exemptions are one-time applications that stay on file forever. Others require you to reapply every single year. Income-verified programs usually require annual renewal. Some senior freezes require annual confirmation. Don't assume you are still enrolled. Ask. Call your county assessor and ask specifically, am I still enrolled? Do I need to renew? What is the deadline? But here is some good news. Some states allow retroactive applications. In Texas, you can apply retroactively for up to 2 years. If you missed years you were eligible for, you might be able to recover that money. Check your state-specific rules. Almost no property tax relief is automatic. You have to apply, you have to meet deadlines, you have to renew some programs annually, and millions of dollars go unclaimed every year by people who qualified but didn't act. That is the application reality, but understanding the challenge is only half the battle. You need a framework for navigating any state system, a step-by-step approach that works whether you are in Texas or Tennessee, Florida or Idaho. Here is your action framework, 7 steps that work in any state for any program. Step 1. Know your current status. Get your most recent property tax bill and assessment notice. What is your assessed value? What exemptions do you already have listed on the bill? What are you currently paying? You need to know where you are starting to know what you are missing. Step 2. Research your state's programs. Go to your county assessor or tax collector website, or better yet, call them directly. Ask specifically about senior exemptions, homestead exemptions, freeze programs, deferral options, and refund programs. Don't just ask, how do I lower my taxes? Ask about specific programs. Get a complete list of everything available. Step 3. Check eligibility for each program. Look at age requirements, often 62 or 65. Residency requirements, income limits if any apply, primary residence requirements. You might qualify for multiple programs, so check them all. Don't assume you don't qualify without checking. Step 4. Get all deadlines in writing, not just the application deadline, but whether it is a one-time application or annual renewal. Find out when benefits would take effect. Put every deadline on your calendar, digital reminders, paper calendar, whatever works for you. Do not trust your memory. Step 5. Apply before the deadline, not on the deadline, before it. Apply at least 2 weeks early. Mail is slow. Systems crash, don't leave it to the last minute. Keep copies of everything you submit and follow up to confirm they received your application. Get a receipt if possible. Step 6. Verify your bill reflects the savings. After you are enrolled, check your next property tax bill carefully. Make sure the exemptions are actually applied. Errors happen. Computer glitches happen. Catch them early. If something is wrong, contact the assessor immediately to get it corrected. Step 7. Set annual reminders. If any program requires renewal, put it on your calendar now for next year, and check for new programs every year. States are adding and expanding programs constantly. What didn't exist last year might exist now. This framework works in any state for any program. Follow it, and you will never miss an opportunity to save. You now understand the formula, assessed value times tax rate. You understand the 5 types of relief, exemptions, freezes, caps, deferrals, and refunds. You see the trends sweeping the country, from record exemptions to elimination efforts, and you have the 7-step framework to take action. Property tax laws are changing. The opportunity to save thousands of dollars is real, but it requires you to be proactive. Don't wait for the system to help you. Use the knowledge you have now to help yourself. Thanks for watching Tax Hack Pro. If this video helped you understand the property tax game, make sure to like and subscribe for more financial strategies that put money back in your pocket. See you in the next one.